The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Pretty good. Happy New Year to one and all.
Oh, that's right. It's a Happy New Year.
90% of all people are probably on a diet, me included. Woohoo!
Oh, yeah, the gym I go to is really crowded now.
Is it right now? Everyone's there?
There's the same people for years. But January, there's a whole bunch of
They
extra.
thin out in February, March,
Yeah,
April. How long do they last?
No, it doesn't take long.
Not at all?
Usually into January.
It
Starts getting closer to normal.
There you go.
By February, March, it is back to normal.
Yeah.
You know?
So
That's just the way it is.
hope everyone had a good New Year.
Yeah, I said I was going to quit all my bad habits, and I'm just getting around to it.
Chris and I decided we're just going to be better. Be a little bit better.
It's a new year.
Yeah.
The Cowboys are still playing football. And the
Fantastic.
playoffs are starting, which is great.
Hey, Sanchez looked awesome, didn't he?
Oh,
Holy
yeah.
cow. Where'd he come from?
I think he just had a bad day.
We can make this a sports show today. He was terrible. Damn.
Yeah, it's just kind of thrown in there, and like I said, I think he had a bad day. Luckily, we got two other real good quarterbacks on top of that.
You know, you have one opportunity all season. You're not second, you're third string quarterback. Here's your opportunity. It's on television. You got a winning line. You got a great team, and you lay an egg.
Oh, no. He might be a listener, so I don't know.
Oh, if you want to call, what's our number, Vic?
No. All right, I want to go over a thing. A lot of people have been calling me on this lately. It's over the years I've got almost as many calls on this as I have annuities, but it's these high CD rates. You ever see those real high CD rates? 4.5% for 6 months. I'm like, what? 4.5% for 6 months? And then you look at it and like, it's FDIC insured.
Load up the truck.
That's right, 4.5%. Blah blah blah. And I said, man, that sounds great. And then it says, you can't lose. It's FDIC. Blah blah blah. But there's always a catch, right?
And the catch is?
The catch is it's some insurance salesmen using it as a marketing tool.
Imagine that.
And what they'll do is basically they'll look at the same place you can. They say they're CD brokers, like experts on CDs. They're looking through a similar program to Bankrate.com that you can get on your own.
Right.
And Bankrate.com is a great website to get CD rates all over the country. But they'll take that and they'll find a CD, like a 6-month CD. Only problem is some of these are lower rated banks. You got to be careful because they're looking for the highest rating. So even though you'll get the 1.25 as long as the bank doesn't go under, then you get the FDIC insurance. But if you ever seen a bank that's been taken over the FDIC, it might take you 2 years to get your money back.
No, it's a lot of red tape. And CD rates like bond rates, if you got a bank from Bankrate.com or this place Vic's talking about that offers a higher rate compared to benchmark what the other banks are, there's a reason. If they need more deposits because they've got too much money loaned out, they're going to offer you a higher rate. The bank that's sitting flush isn't loaning money that much out. They're giving you a lower rate.
But the difference is even the lowest rated bank is not offering 4.5% on a 6-month CD.
That's correct.
They might be offering 1.25 when the going rate might be 0.75 or 1.
Right.
So I'll give an example of how they do it. It's in every paper. It's in the Dallas paper every single week. I've seen it forever. These huge rate CDs, and they look short too. You're like, wow, short CD?
Yeah, right. 6
For that
months?
kind of money? Are you kidding me? Of course I'll take a 5%. All right, here's how you do it. They find one that's paying, say, 1.25, which is on the high end. It's not going to be one of your bigger banks. Probably some regional bank out of state, something like that. Let's say it's paying 1.25. Okay? That means the article said you get 4.5%. Okay? So what they do is they put in the 3%. So if you take $10,000, what's that? $300, but 6 months worth would be $150.
Correct. That's right.
So they'll add. Sometimes they'll send it with the check that you're giving them. So you got a $10,000 CD, and they'll put in the $150, and so your return for that 6 months will be 4.5%. The bank's interest part is only 1.25%,
Right.
and the FDIC would be, the principal. Or
Still sounds good.
That's right. Still sounds good. The only catch is, they make their money selling you stuff. Almost 90% of the time, it's insurance products, and a lot of times it might be the high commission type annuities. It could be high commission life insurance. But they basically use it as a loss leader. In other words, they got a client looking for safe stuff, right? And they might be selling fixed annuities, whatever. And so they got a good candidate there. They'll buy you the little one there, the little $10,000 for there, because that cost them $150. Sell you the $500,000 insurance products. It makes them $15,000 or $20,000. They make out like a champ.
So basically, they're paying $150 to get your name, number, and their foot in the door with you to do business.
Right. I think one of them was quoted in an article saying, "We don't bug the people." I'm like, sure you don't.
I bet they have. Do they have a limit of how much you can put at that rate?
Sure.
You'd have to, right?
Sure. And the SEC and the FDIC talks about these particular folks. So here's the FDIC. If I didn't bring my glasses, I said a deposit broker. That's what they call CD guys. Let's do this stuff. Can be anyone from one person working alone from home to someone affiliated with a major financial services firm. There is no federal or state licensing or certification process to become a deposit broker, and the FDIC does not examine, approve, or insure deposit brokers. It adds, CDs sold by brokers can be complex and may carry more risk than traditional CDs sold directly by the banks. There have been a few cases reported of unscrupulous deposit brokers allegedly misleading or defrauding investors. Here's the SEC. That's the Securities Exchange Commission, does all securities. Okay?
Yep.
Since brokered CDs are sold through an intermediary, you'll need to take extra steps to avoid fraud. Recommended precautions include thoroughly check the background of the deposit broker, identify the issuer. There's a guy from CBS. He steered to the lowest Safe and Sound rating, had the lowest rating on Bankrate. In other words, he looked at bank rates of the ones they're offering. It was the lowest ratings of any CDs offered out there. Ask your deposit broker's record keeping and find out what happens if you need to withdraw your money early. Better yet, just say no to CD brokers.
It sounds bad because you've got an insurance guy and he's buying your name and paying you a little extra interest for the opportunity to work with you. But if you think about it, all of us get this the stuff in the mail all the time from banks. They do it all the time for new money. In other words, if you have an account with them, you don't get that 1% money rate. But if you send them new money, usually a minimum of $10,000, maybe a minimum of $25,000, you get their ATM card. You use the ATM card a minimum of 5 or 10 times. They have all of these stipulations. Then they will give you 1% on your money, and it's usually only for a year. So it's real similar.
All of it is dealing with part of my axis of evil.
That's right.
Which you know.
That's right.
Banks, airlines, electric companies. What else is the axis of evil?
I know banks top the list.
The airlines, when they started charging you extra fees for everything that has 1 inch on your leg of leg room, baggage and everything else. The electric companies, because they said we have to raise these rates because this natural gas price has gone crazy. It's gone down for 10 years now, and they haven't lowered a penny, right?
They raise your rates to help them fund a plant, which is going to save you money in the long run, and the long run never comes.
That's right. And banks are the number one axis of evil because they'll charge you 20% on a credit card, give you 0.1% on your bank deposit account.
That's right.
And if you are late on any credit card, if you just went out of town and forgot one of them, not theirs, they could raise you to the default credit interest rate. This is like 30%.
Immediately, yeah. And they get the gold star because they've been the top of the axis of evil list for the longest, right?
That's right.
Hundreds of years.
I've had this list for almost 30 years, and they're right there on my top of my
Back
nose.
to the old usury laws, right?
Then you see another Wells Fargo, misleading, doing sales contests to screw people, blah, blah, blah. It's just never good. I've dealt with a corner office guy at some of the big brokerage firms. They're usually pretty sharp.
Yeah.
You deal with one of the bullpen guys, you're getting what it's a new guy learning.
On your money.
That's right. They're learning on your money. But anytime I've talked to some bank brokers, they typically seem to be the most uneducated. There's a extreme lack of knowledge for their product. I had one of them bring me, it was a variable annuity, and my thoughts on high fee variable annuities.
Yep,
Not a good choice usually. They were telling me that this is the way it was, and I go, well, that is not the way it was. So they brought in the head trainer for this particular bank in all of the Dallas area, and they got me on the phone. They said, Mr. McClure, I am the head trainer for this, blah, blah, blah.
I remember.
I got the insurance company on the other line. And they said, Mr. blah, 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 you need to retrain all of the people at all of the branches because Mr. McClure is correct.
That's right.
I go, it's on page 74 of the prospectus. I don't make this stuff up. But clients don't normally look at a prospectus.
No, but there you have some good safe money options out there. We do this all the time. We pride ourselves, as you know, listening to the show, our philosophy is to take care of your hard costs first. You have to do that with safe money. Liquidity is an important part of planning. It's expensive because you don't make that much. But if you have any questions or if you're looking at some, call us, 972-715-2424.
That's it. You can always go to our website at ilovemyretirement.com. Stay with us, folks. We've got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, folks, if you'd like to take advantage of our no-cost, no-obligation retirement plan, retirement stress test, our Social Security Optimizer, you'd like information on the commercials you've heard for 30 years, 20-something years here in Dallas, about annuities, about stocks and bonds, whatever, don't hesitate to call our hotline at 972-715-2424. Again, 972-715-2424, and you can always go to our website at ilovemyretirement.com. There's a couple things, just quick. The reason I called this the Common Sense Investing Show years and years ago is because I truly believe if you break everything down to its common sense components, investing is not as hard as people make it out to be. If somebody tells you put all your money in one tech stock, that can't make sense if you put a common sense test to it. Put every dime you have into a money market making 0.1% when inflation's 3%. That can't make the most sense to you. All right. Buying something with a 20-year penalty or 30, that can't make a lot of sense to you. Or ruling out entire asset classes because you don't sell them. Like I said, if you're a broker that does insurance products, stock market's terrible. If you're a stock market guy, annuities, insurance is terrible. Or a bank guy, they're all terrible. I only see these. All those do not make sense.
No, and if someone tells you they have the magic bullet, no matter what business you're in, you can compare it to your own. There is no magic bullet. You hear these technicians out there that are technical traders, and if you have the right formation, you can make money. Everyone's pretty familiar with the Head and Shoulders. Can be bearish, can be bullish, and if you see that formation, you can load up. Well, nothing is absolute in this business. You have what we referred to as a January effect that they talked about. As January goes, so does the rest of the year. You have sell in May and stay away because of the summer and it's slow. These are guidelines, and what we try to do, and with common sense, is stay within the guidelines. If you look at the January effect, last year in 2016, January and February were terrible. I think January itself was down, 4.5%?
No, I think it was down 6 or 7, actually.
Well, and that would indicate a poor year, right? Well, what didn't it take and we always say things come up that aren't planned for. What didn't that take into consideration?
The Trump effect.
The election.
That's
We're
right.
having an election in November. Everything completely changed and it ended up being a good year. So you just, again, like Victor was saying, you've got to use your common sense. We're here also to help you and kind of guide you through. Use these things certainly for a reference point, perhaps a benchmark, but there are no absolutes. And if someone is telling you they've got an absolute, run.
It's funny. 90% of the pundits thought Trump would lose.
Right.
90% of them probably thought if Trump were to win, the stock market would crash.
Well, Mark Cuban, and I hope you're listening, he was on all the television shows months before the election saying he had his Trump hedge on because he knew when Donald got elected, the market was going to crash, and I think it had something to do with buying calls on gold or whatever, but he was wrong. So whatever he did, and if you followed him because he's smart, he's got all this money, he must know what he's doing, right? Well, you had it wrong. If you had have followed him because he's got all this money and you didn't have a lot, you would have lost.
Trying to figure out which direction the market will go is a loser's game. It always has been. It always will be. when we design portfolios and retirement portfolios, we design them as such it doesn't matter what the market does. You're always going to have your bills paid.
Not everyone does that.
That's right. You will have your bills paid. Now, for legacy purposes, a lot of other purposes, you need the other stuff. You need the liquidity, especially. You really need liquidity.
Yep.
So I think stocks are fantastic. I think cash is. Cash isn't paying anything right now. I get that, but cash is king. There's opportunities you can do with cash. Plus, you have those reserve requirements. There was an article Chuck Jaffe for MarketWatch was talking about a personal stress test. Remember, if you listen to this show, that's what we promote.
We do one of those.
That's right. Take advantage of a stress test. What happens is people think they really have. They think because they know something about finance or a little bit about the market, doing the same thing during retirement will work just like it was when you're working. That doesn't necessarily
apply.
Not necessarily true.
It doesn't. Yeah, it doesn't always apply.
Right. And they're talking about you need to get a stress test on your portfolio. And they said one of them you can do your own is act like you quit getting your paycheck.
Ouch.
That's right. Just put it in a side account for
Right.
a few months and see when it started hurting. And for most of Americans, it starts hurting month one.
Yeah.
And so they're talking about 6 months to a year worth of cash for emergencies. Remember, my thoughts have always been 3 to 6 months when you're younger. As you get older, 1 to 2 years worth of expenses in cash.
I talked to a client Thursday morning, and he said, Guy, I was coming into an additional $20,000. Maybe we could do something with that. And my first thought, knee-jerk reaction, I asked him, I said, well, do we have a year's worth of reserves built up? And he thought about it. He goes, no, I got 6 months. I said, there you go. As we said in the last segment, liquidity is important, but it is expensive because you don't get paid much on that money. So he's going to put that in his reserves and work towards getting that year.
Think about that, guy. We've been doing this for 30 years apiece.
Right.
I think the most advice I ever give is about the reserve requirement.
Yeah.
I get people all the time, hey, I got 100,000 extra. What can you do with it? You're my guy. You're my man, whatever.
Right.
And that's the first question I ask them is, all right, what kind of reserves do you have? If they have them, then we start looking at things, right? If they don't, keep it in cash. Now, remember, you talk to 99.9% of advisors out there, and you tell them they got $100,000 or $1 million. What are you going to do with it?
Oh, I got something for you.
Believe me, they'll find something.
Oh, yeah.
If they didn't have anything at the tip of their tongue, which I doubt, they're going to find something and find it quickly. If it pays commission and a good commission, the better, right? But 90% of the time, we do the just opposite. And that's why neither one of us had a complaint in 30 years either, is we're trying to give you well-balanced advice. We call this show the Common Sense Investing Show because does it make sense not to have a reserve when the market is volatile or whatever? Of course it doesn't. We got a break coming up. Stay with us, folks. We got more great show coming. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. I'm going to finish up this why you need a stress test segment, then they'll move on. Why you need a stress test, besides acting like you're not getting paid. Let's say you're about a year from retirement. Act like you're not getting paid for about 3 months and see how you do, or 2 months, whatever. That's a good self-test. Our test that we do,
and that's a partial test.
That's right, is much more comprehensive. What you have to do is assume a certain interest rate on cash, assume a certain interest rate on, bonds, CDs, a certain return on stocks, and a certain inflation rate. It'll show you if your money will last. It'll show you if you've got an inflation rate of 3% and you got $5,000 a month in expenses now, what does that mean when you're 75, 80? That's going to be $10,000, $15,000 in expenses just to maintain the same lifestyle, not a better lifestyle. You have to put all of those things in. There's other things. When you're 70 and a half, everybody knows there's something called an RMD, required minimum distribution, that comes out of your retirement accounts. When that comes out, you got to pay tax on that, right? Well, this program will show you, okay, what effect does that have on your portfolio? What effect does taking annuity income have? How about dividend income? Capital appreciation, all of these different things, and the taxation of each thing, it goes into our no cost, no obligation program, and it'll give you the actual numbers. And you can see, all right, I think I'm going to retire next year. or 4 years from now, 5 years from now, and you'll see real quick if you're on track or you got a long way to go.
Yeah, and at the risk of being redundant, and I say that because we've gone over this a lot, the stock market used to average, I say used to, up to the last 10 or 15 years where the S&P's barely averaged over 4 with dividends, used to average, the number was about 10% plus or minus. And you could do the math in your head. Well, if I make 10% of my 500,000, it's 50 grand a year. I only need 40, so I'll be actually saving money. If you do that sort of stress test to get yourself in the ballpark, it doesn't work, because if the market loses 20 and you're withdrawing 10 and all sorts of different things, it just doesn't come out right.
No, you call the death spiral.
That's right.
You take a large loss and you're taking out a decent amount during retirement income, you cannot recover. It is mathematically impossible. And so if you have a question about that, or you'd like to take advantage of the stress test, don't hesitate to call our hotline, 972-715-2424.
Hey, before you jump to the next article, I was going to kind of prioritize a little bit, perhaps, for the listeners, the order in which you should save. We talked a lot about liquidity and the expense of it and taking care of the hard cost. The first thing, if you can, is to take care of the liquidity, because remember, that's the first place we look, knee-jerk reaction. Make sure at least you have 6, but hopefully 12 months. So that would be number 1. Would you agree?
Absolutely.
And if you can, number 2, and you can dovetail it with inflation hedging as well, but number 2, as we always talk about, is making sure your hard expenses are taken in retirement. In other words, come up with a number. Now, this stress test we have will help you. It'll put a magnifying glass on it. It'll make it easier for you, but you've got to come up with what your cost, what you're going to need in retirement. And then you figure out how much income you have, Social Security, if you have any pensions, subtract the 2, and then you've got the gap that you need to bridge. And that is your hard expenses and plan for inflation. You know, Victor, I was thinking the other day, we've got such great managers for people in our ETFs and all of that, and we really don't spend enough time on that. And right now, everyone's got a great attitude, whether you like Trump or not. Things are looking up. This is only the beginning, and they say 18 and 19, who knows, but it's supposed to be really good years, and it's a real good time. Sooner or later, we should incorporate that and let the listeners know what we're doing with those managed funds, because it's a good place to go once you have your liquidity and once you have your costs taken care of.
Yes, absolutely. The stock market is the one thing over time that has consistently beat inflation.
Right.
But you still can't have all your money in there if you need a substantial amount of that money to live off of. You just can't do it. You have to have something else that produces consistent income to do that. Otherwise, it'll be a problem. Like if you're supposed to take out 3% a year, you got $1 million. Well, you're living on that $30,000 a year.
Right.
So if the market goes down 500,000, you're only supposed to take out 15. But your bills didn't go and cut in half, so you can't do it. And so that's when the death spiral starts. So that's why a stress test is so important. And like I said, we believe having your money, have all of your bills paid first. Hopefully Social Security and pensions can do that. If not, you need to look at alternatives. So all your bills are paid. And then the stock market and your reserve account are very, very important. We're going to go over an article here after the break that's going to talk about, we'll talk a little bit about Ken Fisher and why he hates annuities. And a couple of professors.
Is he on your list of axis of evil? I just want to know.
No, axis of misleading BS.
Don't get in a fight with Ken.
But we're going to talk about that. Why he said he'd rather go to hell than
he'd rather go to hell and burn.
We'll talk about that after the break. A couple of professors are taking issue with it, and we'll go over kind of that thing. Remember, if you have any financial questions, like to free information kit on anything we do here, don't hesitate to call our hotline, 972-715-2424, or go to ilovemyretirement.com. Stay with it, folks. We got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. I'm doing my copy of O'Reilly. You are now into the no BS room.
Talking points starting now.
No spin zone. That's what
No
it says.
spin zone.
This is the no BS zone. We've talked about this in the past. One of the biggest money managers out there is Ken Fisher. He has doubled or tripled his assets under management since he started attacking annuities. Seems like it's a pretty popular thing.
It took his whole life to get to where he was.
Oh, yeah.
And in a year or two, coming out with the I hate the annuities ads has doubled, right?
That's right. Now he's doubled down. What is the annuity ad say this time?
I'd rather die and burn in hell than own an annuity. What?
Well, we've talked about that before. That's like saying, remember, he sells a managed program that's in stocks and bonds.
Right.
He doesn't do anything else. So anything
He doesn't
beyond
do
this
annuities?
plan is terrible, right? So get rid of all those. He just found some fertile, ripe thing because people have doubts about annuities. And so he just took advantage of those doubts. But you cannot, dismiss an entire asset class. That'd be just like saying mutual funds, that's the devil's work, and you'll go to hell if you sell or buy a mutual fund. It's ridiculous. There's nothing wrong with annuities. They're just tools. Now, I agree with him on some of the stuff. Some of the variable annuity fees are so dang ridiculous. I find it hard. Now, don't get me wrong. To say they have no benefit would be disingenuous. They do have benefit because they've got death benefits and living income riders, regardless of what your cash does. There are benefits. In my mind, I just don't think the cost is worth it. All right. I would rather choose a regular fixed annuity or an index type annuity or deferred annuity or an immediate annuity, much more clear cut. And the fees are either 0 or maybe 1% at the high side.
Well, here's the slippery slope. Let me ask you this. Are there more bad money managers than there are good?
I'd say yes.
Absolutely. And it's the same with every asset class, whether it's fixed annuities, whether it's CDs.
Bonds. Yeah.
You have to be careful, and hopefully you've got some good guidance.
You can't overgeneralize. Like I said, we do annuities, and we don't tell you the stock market's bad. There's nothing wrong with the stock market. Some annuity guys do. But we've also done stocks and annuities for 30 years.
We've seen people really hurt in some annuities, in some managed accounts, stock accounts, futures accounts, but you don't jettison all that and never do them again.
But this is an article. It was why Ken Fisher's wrong about it. This is written by Finky Milevsky. He's a
sounds like a New York mobster. Finky Milevsky.
He's a professor of finance at York University and the executive director of the Fields Institute for Research in Mathematical Sciences.
Sweet.
I don't know where that is, but it sounds smart. Right?
I'm impressed.
Then you got Wade Pfau. He's the professor of retirement income at the American College of Financial Services. We also have articles from MIT professors, Harvard professors, you name it.
Nobel Prize of Economics, all sorts of credentials.
He talks about Milevsky says over 2,000 articles have been written by card-carrying professors in regards to annuities. 99.9% of them are actually positive. What you don't understand is everything out there is marketing, and you've got competing marketing people. The anti-annuity crowd, the pro-annuity crowd, blah, blah, blah.
It's like politicians almost, right?
It's just really popular. It's kind of like politicians. It's very popular to bash politicians. What is the Congress have a approval rate of like 10% or something?
That's right.
Same thing with annuities. It's easy to bash annuities. They don't have as big of a mouthpiece as the guys who've been doing stocks for 40 years.
But make no mistake, they're a lot better than politicians. A lot easier on you.
But what they're saying is, Milevsky says, a lot of advisors don't quite understand why they're selling what they're selling, and so explaining it properly might be an issue. But to tarnish an entire industry is completely ridiculous. But here, let's see what the next part said. Oh, it says lumping those into other types of annuities, talking about, man, there's different types of annuities.
Right.
Some of them have been around thousands of years. Lumping them into the one with high fees as disingenuous, and that's what Wade Pfau says. He says sometimes what Ken Fisher says is they are complex, therefore they're bad. Well, just because you add complexity does not mean it's bad. Now, if it's not explained properly or the clients don't understand it properly,
or you don't understand it,
that doesn't mitigate the benefits, of course, but they should do a better job of that. And that is a challenge. On the annuity front, they are sometimes a lot more complex.
In fairness, we go through a lot of portfolios. People will bring in what they have, their statements, and we'll go through it. And I promise you, 80-90% of them don't know the fees they pay. They really don't know what they're in. They don't understand their stock accounts.
Here's the article. It goes on to say, Americans in retirement need the protection and income that annuities afford, partly because of fast disappearing private pensions and the planned elimination of the Social Security claiming strategies, they need to boost retirement's paychecks. There's a magical secret ingredient, a secret sauce inside an annuity that cannot be replicated by any conventional financial product or synthesized by a traditional money manager, says Milewski. I'm a big fan of annuities that behave like pensions. In other words, use them for what they're designed to do. There is only one thing in the world that can guarantee something for the rest of your life. One. The mutual fund industry a few years ago actually came out with a couple of products that were supposed to compete.
Derivatives.
They couldn't do it, though. They had to close them down because they weren't getting the kind of yields they wanted. They didn't want to take the risk of actually having to guarantee that out. That's how much risk these people are taking, these insurance companies are taking. It said dismissing all annuities is like dismissing ETFs or mutual funds. So what we're saying is you have to take all the information and try to get the bias part out. It is difficult. I would take all of the professors that have no skin in the game. They don't care if you buy a dang annuity or buy stocks or buy anything. I would take their word over anybody that's actually trying to promote a biased product.
And they're not paying millions of dollars to get their name in front of you all the time. It's a difference.
Oh, we got a break coming up, folks. Stay with us. We'll get more great show coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome to the show. We are going over some of a couple of professors took umbrage at Ken Fisher saying he hated annuities, so they were remember, they explained that there's over 2,000 articles written about annuities by card-carrying professors since the 60s. 99.9% of them are positive. And so you can't believe someone that sells a competing product versus a professor that has no skin in the game, in my opinion.
Yeah, and if you want to hear some names that you're familiar with, I've got an article from Lou Dobbs. Also have another one from Susie Orman that are proponents. But they've got to be the right ones for the right solution.
Nobody's saying all annuities are great, because they're not. Nobody's saying all managed accounts are great, because they are not. Or all ETFs, all mutual funds. But chosen correctly, put in the right context, they can be beneficial. But here's what the article says. It says, Ken Fisher says, salespeople mislead annuity buyers into thinking they'll get a high return when they're actually just getting return of principal. Says that is blatantly wrong. It's not true. Most portfolios can benefit from a mix of stocks and an annuity, academics say. By combining an income annuity and stocks, you get the most efficient outcome, says Wade Pfau from the American College. Annuities are better suited than stocks for protecting against longevity risk and investment volatility. Partial annuitization of a portfolio stabilizes the legacy value of the assets. We've talked about that before. One of the hardest things I have to explain to people sometimes is by annuitizing or turning a piece of your money into an income stream, you actually end up with more money for your heirs.
And the way I put it, simple word, is it enhances the return of the other part of your portfolio because you don't have to fool with it. You don't have to draw on it when the market's down.
Now, think about it. Let's say you've got $1 million, okay? And you know you're going to have to need, well, if interest rates are this much, I'm going to need like 800 of this, the interest on 800 of it. And I'd really like to leave my kids this $1 million.
Right.
Okay. Only problem is it may or may not work. If interest rates stay down, it's probably not going to work. If the stock market goes down, it's not going to work. But what if you could take 400,000 out of that, recreate the same income as 800 did before? You never have to touch 600,000. Remember, we're taking 400 for income.
Right.
That's 600,000. If you just make, remember, 7%, it's going to double every 10 years. You got 20 years. You got 4 times, right? You got 3.2 million there. If it makes, so 7% doubles every 10 years, you're going to leave your kids or whatever, $3 or $4 million by taking out 400,000 and making it an income stream.
Now, let me tease the listeners just a tad. The Fed raised the rate about 1/4 point in December, and Victor and I both have received emails from most of the major carriers with the annuities we like, A-rated or better. Been around forever. They provide income, sometimes increasing income for you in retirement. Almost all of them right now across the board have increased their rates.
Right.
There's never been a better time.
And don't hesitate to call us at 972-715-2424. Let me finish this article there. To build an efficient, this is from the article from Wade Pfau, the professor,
Right.
and
Pinky.
Mashi Malevsky.
You're right.
These are all, remember, Center for Research in Mathematics, and these are professors of finance, right?
Cerebral power there.
Said to build an efficient retirement strategy, Pfau says, you need to integrate both stocks and an annuity into the plan. For essential spending, you don't want to be exposed just to the stock market. You want to have something more secure in place. For discretionary expenses, that's where you come up with investing in stocks and be more aggressive. Isn't that exactly what we've told the listeners on the air forever?
And we can send them the article if you'd like it.
Forever we've been saying that. Get your expenses paid by something, a guaranteed, consistent income stream. Right now, annuities just pay you the most income per dollar. You can use a bond if you want. If you want to pay, put in like about twice as much money. You can use CDs. Whatever it is to give you consistent income. Now, dividends are not consistent. They're not consistent.
No, and the
dividends
and the underlying asset can go down in value.
Like I said, this is a professor confirming exactly what the information we've been giving our audience for decades. But that's what you got to do. You got to provide you a peace of mind. It goes on and say that kind of stuff. Remember, does it make sense? I'm going to put all my money in the stock market. I need interest from that to live on because my Social Security alone is not enough to pay my expenses. Or does it make sense that let's take a piece of it? I need $2 more grand a month. Guarantee myself $2 more grand a month plus my Social Security. Then I never have to touch this stock thing.
That's a great place to be.
It can grow as much. I never have to spend it. So the odds are you can take a piece, guarantee all your expenses, guarantee your lifestyle till you die, and leave more to your heirs.
Last segment we were talking about we really need to spend some time and talk about our ETF managers because they do a good job. It should be a good year. And I got to thinking, the reason I think we spend more time on the fixed annuities is when we talk to people and you go through the stress test, they seem to err more towards the conservative side than the risky side. And I can't say that that's bad. And that's why we end up spending so much time on fixed annuities.
Oh, yeah. Malevsky says a reasonable allocation on annuity to stock portfolios in the 20 to 40% range. He said the value of annuities has been long documented by academia, as well as recently by the government. There's a consensus in the professor world. That's why they said 2,000 articles have been written, 99% of them positive about annuities. More of the U.S. Department of Treasury last year issued a statement encouraging 401k plans to offer annuities. So that's why when somebody says, I hate annuities and you should too. Now, really? I mean, you've got professors, like I said, you go to Harvard, MIT, anywhere you want to go, and they say, well, I probably should. A mix of stocks and annuities is the best, most efficient way. Well, that's our show, folks. I appreciate you guys listening today. Remember, if you have any financial questions or like to take advantage of our no-cost, no-obligation stress test, Social Security Optimizer, or just an information kit, call our hotline 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice